good morning to you all. Yeah, the sun did shine over the weekend. It did for us. Gosh, lovely sunny Sunday afternoon. Nice to have you all on board. Key week for markets. Just to remind you or let you know, we had the OPEC meeting, delayed meeting actually. I think it ended up being online, but that was yesterday. And I know there's been a focus on oil. This is, oops, why is that not working? Let's put in that one. I think I've got it open on too many computers. That's my problem. Anyway, no, it doesn't want it. I'll go back to here. Oops. Where that's what I want. Right, is that going to behave itself? I always, yeah. Okay, yeah, oil, there we go. Yeah, ghastly chart as Stuart says. I mean, it is just all over the place. And it sort of tends to happen in a lead up to an OPEC meeting. So what I mean by the OPEC meeting, we were just talking about it, it's called OPEC Plus, where OPEC and Russia meet. Russia isn't actually a member of OPEC, but that's why it's called OPEC Plus. If you recall, for those of you who don't know, OPEC is responsible for about 45% of global oil production, not as much as it used to be, partly because of the huge increase in oil output in the US with the shale oil. But oil prices are determined by OPEC largely because they're like the swing producer, especially Saudi Arabia within the group of OPEC producing nations, and they've been voluntarily, in inverted commas, cutting production to try and limit the price decline. In fact, to try and push oil back up to $100. Nowhere near, I'd say, a long way off. As you can see, oil, ever since the sort of peak in early April, it's come off quite sharply. And this is really down to production increases offsetting the production cuts from OPEC Plus. And I think that's their problem. I know they agreed over the weekend to extend these voluntary cuts that Saudi Arabia and Russia have introduced, which are about 2.2 million barrels a day. But they still haven't decided on what's going to happen in the fourth quarter this year and then in 2025. So oil it's subject to quite a bit of volatility depending on what OPEC comes out with. Anyway, get back to the other markets. Stock markets, have a quick look at the S&P 500. That's the sort of benchmark of the markets we follow. It was a shortened week in the US as well as here in the UK, not in Europe. So we only had 4 days last week. We were hit mid last week, just looking at this candle here. This was on Wednesday. This was down to a bond sell-off. Oops, have I missed some questions? Sorry, I hadn't scrolled down to apologize. Yeah, this sell-off here was down to a bond sell-off brought about by weak demand in the US for what turned out to be a 7-year Treasury note auction. Anyway, cut a long story short, it was a poor auction. It was a poor auction the previous day for the 2- and 5-year notes as well. And this sent bond yields to their highest level in just under a month. And that caused equities to come off. Why? Because higher yields results in higher borrowing costs typically for companies. And that's why the S&P fell. That's a big fall, actually. It's its worst day in May, definitely. So it fell, 0.75% in a day. And the NASDAQ also falling quite sharply as well. Anyway, despite the midweek slump, most markets recovered. We've got, let's take off that. By the way, this Forex factory, it's always a good idea to just take off the low impact ones. These are the yellow ones. So if you click on this filter here, if you've got this open in your browser, go to the expected impact and uncheck the yellow one. Uncheck the yellow one and then click apply filter. This then makes it more manageable because we're only interested in the main events, and the main ones being the medium and high impact ones. Anyway, just going back to last week's to look at that PCE, the Personal Consumption Expenditure. This used to be a little known release, but actually the Fed have made it very plain that that is the rate of inflation they focus on rather than the regular CPI data published by the Statistical Office. Anyway, that came in as expected, although it looks slightly lower on the month-on-month reading, but the 2.8% reading for the core rate, which excludes the volatile food and energy components, it actually helped calm the nerves. And as you can see here, we actually had, let's look at the S&P 500. We actually had a lot better day on Friday. In fact, the Dow Jones had one of its best days all year. Huge, huge. Yeah. And that's all down to the fact that inflation perhaps is still possibly going to come back down again. And this is what's been causing markets to go through these sort of wobbles that we've seen. This is the Dow. Go back to the S&P. Same sort of thing. It's the markets have been a little bit volatile as they've readjusted or adjusted to the fact that interest rates are not going to be cut much this year at all. We're still only expecting 3. Oops, that's not it. That's the one I wanted. Sorry, I moved from Edge to Chrome, and Edge is not. So anyway, the point I'm making is currently rates are at 5.25% to 5.5%. If you go to the year end, it's only going to be cut by 1, possibly 2 cuts, with the first cut possibly happening in September. So already a Fed official that recorded a podcast last Friday has come out and said that he expects interest rates to stay higher for longer. And I think there's just been a further and further erosion of expectations. And that's actually what's caused the dollar to rally from its low point this year. Anyway, that was equities. We had a slightly better outcome from the week in the end. I mean, the S&Ps was slightly down on the week. So was the Dow, despite that massive day on Friday. Same with the NASDAQ as well, down 268 points on the week. Here's the NAS, particularly volatile, a very big day on Friday, with the market opening really through the floor actually, and then recovering quite dramatically. And I suspect a lot of you do know of this stock called Nvidia. It's one of the Super 7. 20 minutes, it rose 500 points. So Pete says in the last 20 minutes, the Dow rose 500 points on Friday. That is very much a month end sort of shenanigans, Pete, I'd say, as you approach the end of the month, and a lot of fund managers perhaps might have been short the Dow long the NASDAQ, you don't know. But yeah, I find that fascinating. Anyway, Nvidia on Friday, it ended up, I believe, it valued the stock. Let's just get my numbers right. Okay, so it's since its results on May the 23rd. So Nvidia is a chip making company. It originally positioned its new chips, or designed its new chips for crypto mining, but over the last sort of 9 months, there's been massive demand from AI because of the processing power needed to power these bots. And Nvidia's the demand for its chips have just be gone through the roof. I think Meta alone ordered $15 billion worth of NVIDIA chips. Anyway, its results on May the 23rd were pretty okay. The stock jumped 2% initially, but since then, the company's value has increased by a staggering $350 billion. I mean, it is mind-boggling. This company is now worth $2.7 trillion. It's frightening. I wouldn't. I know you're going to say, would you sell it? I wouldn't recommend doing anything in a stock that is going through the roof like that. And when a market's going higher, it's because there are more buyers than sellers, not more sellers than buyers. But you just can't help think when it does turn, it could be horrible. Anyway, UK markets, just very quickly. Yeah, I think I'd call it a bout of profit taking, really. I know GSK's fallen quite sharply this morning because of the was it the Zantac ruling? It was, I think, in the FT there was a report. Oops, I'm in a different browser, so it's wanting me to sign in. Yeah, they're in the end. Okay, so yes, I did see some reading about, okay, GSK shares, yeah, 10% because of the Zantac ruling the end of last week. So that's probably denting FTSE at the moment. But aside from that, I would have thought a lot of what we saw over the last couple of weeks is profit taking following that strong run up since mid-April. And I think the mood in global bond markets last week probably didn't help, although I think the outlook in the UK, I think it seems rosier than most economists were expecting, certainly at the start of the year. And I note that a recent survey by Lloyds Bank recorded business confidence at a 10-year high, which I don't know, it suggests the economy is building up some sort of momentum, really. I think companies generally feeling more optimistic about their prospects. Of course, this is sort of something that the Monetary Policy Committee will take heed of because, will they want to cut rates in June? I think it's probably unlikely, bearing in mind the election on the 4th of July. Anyway, Eurozone markets, just looking at the DAX, always a good benchmark for the Eurozone markets, gripped by interest rate speculation. We'll be discussing that in a second, but the ECB could well cut interest rates by 0.25% from a record high of 4%. We've had a jump in inflation in the Eurozone. Are they going to do it? And what's the implication, etc. We'll get onto that in a second, but that's certainly dominating the Eurozone markets. The DAX ending up down 113 points on the week, but like all global markets, had a very good day on Friday. Yeah, currencies, just looking at the euro here, the main pairs against the dollar, the euro, sterling, and the yen. Certainly range bound last week ahead of this ECB policy meeting this week. And I think despite expectations for a rate cut in the Eurozone, I think analysts, Forex traders particularly, are less convinced that the European Central Bank is going to follow this up with further rate cuts this year. So that's one of the reasons why the euro has strengthened, recovering from its lows back in mid-April. Why it's not coming off again? Because I just don't think it's as clear as I think analysts and economists have been caught out once or twice this year. I think they're reluctant to nail anything to the mast for the time being. Okay, gold. Well, we all know all about gold. It's dominated by Chinese retail demand, Chinese central bank buying, and it remains quite volatile. I mean, these are huge candles, by the way. I mean, you're talking sort of $50 moves. In percentage terms, of course, not such a big percentage move with the price up at 2,400 rather than at 2,000, but volatile. Yeah, definitely volatile. Oil, well, we've discussed oil already, so let's get on to the calendar. Get on to the right month. There you go. Right. Bank holiday in New Zealand. Another one. Go and live in New Zealand. So it's an important week for the Eurozone markets. We've just been discussing the ECB policy meeting. We've also got non-farm employment change. For those of you who are new to our webinars, the section I cover off is the tea leaves, the fundamentals. Almost all of our work focuses on the technical analysis. That's the price action in the charts and our strategies. But often, a lot of you all want to know a little bit about what's driving our markets, and that's the reason why I chime in with my section. And with some of the analysis, we look at what implication it's got. And with non-farm employment change, this is this one down here, effectively this is the release of the employment data. It's called non-farm. They exclude the more volatile farming sector, which is very seasonal, so jobs are jump up and down depending on the seasons, so they remove that, so it's called non-farm employment change. And we're interested in how many hours people are working, what the change was, if there are any amendments from the last week, the last month I should say. And what's interesting is it informs Federal Reserve policy. So the Federal Reserve, the US central bank, it will be influenced by the employment data, because unlike other central banks, the US Federal Reserve, the US central bank, has got two mandates. One, to manage price stability, so to keep prices in check, and that's really related to inflation and the PCE data that we've discussed earlier. And its second mandate is to foster full employment. And so obviously, employment data or unemployment data will have a direct bearing on Fed thinking and policy decisions. So it's really important for the markets, this employment data release. There you go. So let's chug through it. ISM, manufacturing PMI. There are two manufacturing PMIs out on today. The one I'm more familiar with is the ISM manufacturing PMI data. An uptick in activity there, so it's a measure of manufacturing activity. With all these indices, above 50 indicates an expanding sector, below 50 indicates a contracting sector. And you can see here that it's picking up. And that's the problem with the US economy. Strong in employment data, strong service sector. When the economy is doing well, how can the Fed cut rates the way that some of the market participants expected at the start of the year? That's really the nub of it. Wednesday, nothing much on Tuesday. Inflation data in Switzerland, we don't really focus on that. So let's jump to Wednesday. We got this thing called the ADP employment change. This is a private payroll company that does the payroll for a whole multitude of different companies, and it's got its own take on the number of new jobs because it's doing the payroll for these companies, so it gets a pretty good idea. It's quite volatile compared to the official data from the Bureau of Labour Statistics on Friday, but it gives a bit of an indicator. I don't think the markets react much to it. It's less impactful really than the Friday data. Anyway, 175,000 new jobs, pretty similar to the official data, if that's what comes about. We then have the Bank of Canada's rate decision. Typically, the Bank of Canada is very mindful of what's happening with the Federal Reserve in the United States. No change expected here, but there is a press conference, so you might have a little bit of volatility in the Canadian dollar. ISM services, so this is the other part of the economy. There are two sectors to an economy, manufacturing and services. The services PMI more people employed in services and in manufacturing, definitely in the UK for sure. It's sort of an 80-20 mix there. But here we've got a big jump back up in service PMI data. We had a surprise fall last month. It just didn't look right, that 49.4. Anyway, the dollar will be sensitive to this release. And then the main event, we've already sort of mentioned it. This is the European Central Bank policy meeting, the Governing Council meeting to deliberate on interest rates. And I think despite inflation ticking up to 2.6% from 2.4% in May, the Governing Council, a lot of members have almost nailed their, thoughts to the mast. And I think CAD forecast rate cut. Oh, wow, is there? I thought there wasn't a rate cut. Oh, it is. I've got a report saying that there is no rate cut. That's really interesting. You pointed that out, Paul. Thank you. Well, that just goes to show you it's different on Forex Factory to compared to the notes that I've got. So possible rate cut. Well, even more important that we focus, if you got a CAD position ahead of as a policy meeting by the central bank, just be very careful about any intraday positions you might have. Not that anyone does trade CAD intraday, but just in case you do. Thank you for that, Paul. Appreciate it. European Central Bank, as I said, I think most members, quite a few members of the Governing Council, and it's quite a big committee, have almost nailed their colours to the mast, and I think it's likely that we are going to get that rate cut from 4.5% to 4.25%. It's actually sort of banded. I think it goes 4.25% to 4.5%, and then go to 4 to 4.25%. So yeah, press conference will be quite interesting, partly because the ECB have always said that they're data dependent, they're data driven dependent. So if the inflation data again comes out in June and is not good, i.e. it shows another rise or not a fall, because there are suggestions that there are one-off factors that cause this jump in inflation. And the market always wants to know what's going to happen. Once it's been told something, it likes to know, it wants to know what's the future going to be. Anyway, the Eurozone assets and probably global assets will be particularly sensitive to what the Eurozone bloc does with its rates on Thursday. So that's definitely one for your diary. So the announcement at 1:15 with the press conference at 1:45. And then we jump to another main event of the week, the US non-farm employment change, a strong labour market, along with inflation higher than desired. And these are the two reasons why the Federal Reserve will be keeping rates higher for longer, as some Fed officials have underlined. So we're looking at 185,000 jobs, similar to the ADP data, actually. But as always, just be careful about these revisions. They'll often revise previous month's data, the 175. Sometimes you'll get a number coming in better than expected, i.e. a higher number than 185, and then the previous data is downgraded. So you do get quite a lot of volatility, because it's a difficult, they collect the data and then they release it the first Friday of the new month for the previous month. So you can imagine the scale of the data collection that goes on. So it is subject to revision. Average earnings ticking up as well. That's something that the Federal Reserve will be looking at as well. It's a strong economy, the US economy. Not as strong as some people thought, but it's certainly stronger than anything we have in Europe. So you want to know why interest rates aren't rushing to come down. That's the reason. Pete, inflation data means little now because prices of goods and services are still the same as pandemic times. So nobody will ever feel any financial benefit. Well, it's really interesting you say that, Pete. Remember, inflation is the rate of change of prices. So all that happens as inflation comes down, the rate of change is reducing. it still means they're going up, but nothing like as fast. And as for prices, having had sustained inflation of 11.1% here in the UK, unless we have negative inflation, referred to as deflation, prices are remaining higher. You're quite right. And we're not going to feel any financial benefit unless our wages and salaries are going up more quickly than inflation. That's the reason why we'll feel the benefit, not because inflation is coming down, because prices are still a lot higher. No, good point. Thank you, Pete. Two good points. Yeah, as well as Pete pointing out my miss on the Canadian rate cut. So anyway, so it's obviously a possibility of rate cut from Canada. Yeah, that's it. Thank you very much for listening. It's gone on a bit this morning. I'm not sure. I think was it Stuart a bit late handing over to you? He probably was actually. Listen, have a very good rest of the week. We have a full week's worth of trading. A really important week for the Eurozone with this rate cut, and that will be affecting not just the euro, all of the euro pairs, but also equities. So the Dow stocks, Euro stocks 600, I should say. Obviously the DAX and the CAC and the MIB and all the other European indices. So it's a big event, and it will have an impact on UK markets as well. So yeah, something to look out for. Less than 30 minutes. Thank you, Michael. I've managed to deliver my words in less than 30 minutes, Michael's pointed out, but good. Listen, have a good rest of the week. I hope you enjoy the weather. Doesn't look too bad actually, and hopefully we'll get some markets behaving themselves a little bit more. Thanks very much for listening. Catch you again next Monday, 8 o'clock. All the best. Bye for now.